Okay, we're in exercise 18 21B, dealing with accounting for installment sales, where that installment sale also involves a repossession. So here's what we've got. We've got a company that enters into installment sales that it accounts for under the installment method of accounting. It's possible to enter into installment sales and not use the installment method of accounting. The installment method of accounting is only appropriate in certain circumstances, as we discussed in class. In this particular case, though, we are applying the installment sales method of accounting. So in 2014, let's start with that year. We've got $600,000 of installment sales. The cost of those sales was $480,000. There's some G&A stuff, G&A expenses that are described to you. That's just a distractor. That's irrelevant information. And we're told that out of those sales, we collected $250,000 of cash this year. Okay, so I'm going to kind of work the problem in a little more depth than what was actually called for in Part A and Part B, just so you'll see the whole big picture. Okay, so let's first calculate our gross profit rate on these sales that took place this year. So this installment sales in 2014, 600,000. Cost of those sales, 480,000. So the gross profit on those sales, the difference between 600,000 and 480,000, or $120,000 gross profit on the sales. The gross profit per dollar sale, or the gross profit rate, is 120,000 gross profit divided by the amount of sales, 600,000, or 20%. In other words, for every dollar of sales revenue, we earned or generated 20 cents worth of profit. Okay, we're told that we collected cash of $250,000 during 2014 on those sales. Okay, so here's the story. When we first made those sales over the course of the year, we booked the sale just like any other sale. Debited accounts receivable or installment receivable, credited sales revenue, debited cost of goods sold, credited inventory. Booked the transaction just like we normally would for any type of sale. Then at the end of the year, we prepare an adjusting journal entry in order to defer recognition of profit on these sales and to recognize the appropriate amount of profit based upon the extent of cash collections during the year. So at the end of 2014, we would have prepared an adjusting journal entry that looks something like this. We would have debited sales revenue for the entire amount of the sales that we made, which was 600,000. We would have credited cost of goods sold for the cost of those items, and we would have credited an account called deferred profit. That's a balance sheet account. Deferred profit on installment sales would be actually the full title. It's a balance sheet account that we're going to report under liabilities as unearned profit, if you will, or deferred profit. And that's what, $120,000. Okay, so what that does is that undoes it. It's an undoing of the recognition of the profit on the sales and a transfer to the deferred profit account of the entire profit on the sale. Then we go back at the end of the year and prepare a second adjusting journal entry. This is the first adjusting journal entry at the end of the year. The second one is to recognize, to transfer out of this deferred profit account to an income statement account called gross profit realized on installment sales, the amount of profit that we should recognize given the amount of cash that we collected. Okay, so this year we collected $250,000 out of the $600,000. So the amount of profit that we should recognize is calculated by taking this $250,000 cash collection amount here and multiplying it times the gross profit rate on 2014 sales of 20%. So $50,000 is the amount of gross profit that we want to recognize this year. So what we're going to do is we're going to prepare a second adjusting journal entry debiting deferred profit for that 50,000 there, and the offsetting credit to that is going to go to the income statement account that you see described here, gross profit realized on installment sales. I don't have enough room for that, so I'm just going to abbreviate it gross profit realized. Okay, so let's update our deferred profit T account here to reflect all this. We've got a credit here of 120,000. That's the profit deferred on 2014 sales. And then we're going to debit the account for this $50,000 here, which is the profit that we're going to recognize okay, so at the end of 2014, the balance in our deferred profit account is $70,000. Okay, so here's how all that stuff's going to map into our 2014 financial statements. We're going to have, sales revenue of some amount from all other sales, excluding these sales here. Cost of goods sold relating to all other sales other than the installment sales. Gross profit on all other sales other than the installment sales. And then there's going to be a line item, gross profit realized on installment sales, that represents this $50,000 that our adjusting journal entry here booked as the amount of profit that we need to report on this year's income statement based upon our cash collections on these installment sales. So that's just going to appear as a line item on the income statement. On the balance sheet, okay, so I guess we need to set us up a T account here for accounts receivable too. Okay, so we've got when we originally booked these sales, we debited accounts receivable and credited sales for $600,000. So I'm going to drop that $600,000 in there. That was the dollar amount of installment sales made this year. And we collected cash of $250,000. That's what the facts of the problem tell us here, is that we collected $250,000 cash. Debit cash, credit accounts receivable. So at the end of the first year, our balance in accounts receivable here was the original debit to the accounts receivable minus the credit representing cash collections, or $350,000. That is going to show up on our balance sheet here as installment accounts receivable. We're just going to report the balance in that account receivable account. And then under liabilities, we're going to report the balance in this deferred profit account. And the balance in the deferred profit account we calculated there to be $70,000. So, and that would be classified as either current or non-current, depending upon the portion of the receivables that are due and payable over the course of the next 12 months. Okay, so let's do the next year now. So in the next year, our installment sales, according to the facts of the problem, were $530,000. Our cost of those sales was $434,600. And our total gross profit earned on those sales was $95,400. And our gross profit rate divide gross profit on 2015 sales by 2015 installment sales. Our gross profit rate that year was 18%. Okay, our cash, according to the facts of the problem, we collected in 2015 $285,000 of cash that pertained back to those sales that we made in 2014. And we reported or we collected $168,000 of cash here relating back to the 2015 sales. Okay, so now let's go ahead and update our accounts receivable T account quickly over here. So we made another $530,000 worth of sales this year, so we would have debited receivables, credited sales for that amount. So I'm going to go ahead and update the T account for that. And then we collected $285,000 on sales we made last year, so debit cash, credit accounts receivable, $285,000. And then we collected $168,000 on this year's sales, debit cash, credit accounts receivable, $168,000. So the balance in our accounts receivable at the end of 2015 is what we began the year with, plus current year sales on account, on installment account, less last cash collections from last year's sales, less cash collections from this year's sales. $427,000 is our ending balance in accounts receivable. Okay, once again this year we would have reversed out at the end of the year. We would have prepared an adjusting journal entry to reverse out the sales that we made this year. So this was the entry from 2014. Over here I'm going to make the entry for 2015. We would debit installment sales $530,000, credit cost of goods sold for the cost of those sales, shown here to be $434,600, and then deferred profit would simply be credited for the difference between those two amounts, $95,400. So to give myself a little room, I'm going to move this T account up. Going to move that T account up. It didn't like that because I had a merged cell. Okay, so now I'm going to post the credit to the T account of $95,400, representing the portion, representing this year's worth of profit on installment sales that we're deferring. Profit deferred on 2015 sales. Okay, and now the next thing I need to do is I need to go figure out how much profit we need to transfer out of this deferred profit account over to the income statement. And here's how we're going to do it. There's two parts of the calculation. We got to calculate how much profit on 2014 sales to recognize and how much profit on 2015 sales to recognize. So the amount of profit on 2014 sales that we're going to recognize, we calculate by taking the cash collected in 2015 on 2014 sales. That's this $285,000 here. Now follow closely because this would be easy to get confused on. And you multiply that times the gross profit rate on 2014 sales, $57,000. So by virtue of collecting $285,000 cash in 2015 on 2014 sales, we're going to recognize $57,000 worth of cash. Again, that's cash collected on 2014 sales multiplied by the 2014 gross profit rate. Now we need to calculate how much profit to recognize on the 2015 sales. We're going to calculate that by multiplying the cash collected on 2015 sales times the gross profit rate on 2015 sales, which is 18%. So the amount of profit we're going to recognize this year is the sum of those two amounts, consisting of $57,000 of profit on 2014 sales and $30,240 on 2015 sales. So the total gross profit that we're going to recognize is $87,200. So what we're going to do is we are going to prepare an adjusting journal entry that debits deferred profit and credits gross profit realized. So we're transferring out of this deferred profit account and carrying it over to report it here. Where's the income statement? To report it here on the income statement. Okay, so debit deferred profit, the $87,240 here. Credit gross profit realized, same amount. Now let's update our T account. So we now need to debit the deferred profit account by this debit we made in this end of year adjusting journal entry of $87,240. So let's see, let's extend down our T account and let's figure what our end of year balance is. Our end of year balance in the T account is going to be what we started the year with, plus the amount of profit that we deferred this year on 2015 sales, less the amount of profit we recognized on 2014 sales, and the amount of profit we recognized on 2015 sales. So the bottom line balance in deferred gross profit at the end of the year is $78,160. So here's how all that stuff's going to fall into the income statement and balance sheet. Over on the income statement, this profit that we realized through this journal entry is going to be reported there. $87,240 gross profit realized on installment sales. That's how that tracks into the income statement. Over on the balance sheet, we're going to drop in the balance of our installment receivable, which we previously determined here to be $427,000. And we're going to drop in here under the liability section of the balance sheet the balance in this deferred profit account of $78,160. Okay, now the last thing before we get to part B of the problem is I ask you whether or not you think this deferred profit account meets the definition of a liability. We are reporting it on the liability section of the balance sheet. Does it meet the definition of a liability as established in the conceptual framework of accounting? The conceptual framework of accounting defines a liability to be a probable future sacrifice of economic benefits arising from a current obligation that stems from a current or past transaction. To me, deferred profit does not represent a probable future sacrifice of economic benefits. Therefore, it does not strike me as meeting the definition of a liability. So we have a case here of an inconsistency between the way we do something under GAAP and what our underlying conceptual framework tells us that we ought to do. That's why installment sales is not frequently used, is because although it has historical precedence, it's really inconsistent with what our conceptual framework says we ought to be doing. Okay, so now we're in part B of the problem. In part B of the problem, we're asked to account for the repossession of an item of inventory. So in 2016, what happened was an item of inventory that we sold here in these installment sales in 2014, one of the customers there defaulted. At the time the customer defaulted, they still owed us $12,000. This item of repossessed merchandise, the thing that they had that we went out and got, think repossession of a car for example, had a value of $8,000. We're asked to prepare the entry to record the repossession. Okay, so here's the deal. The easy part of the entry is the debit to the repossessed merchandise. We're always going to book that at fair market value. And the fair market value here of that repossessed item is $8,000. So debit repossessed merchandise for its fair market value, $8,000. The second easiest thing to do is to remove the installment receivable from our books. Whatever they owe us, we remove from the books. So they owed us, according to the facts of the problem, $12,000. So since they no longer owe us that because we repossessed the item, we're going to remove that receivable from our books. Credit installment receivables, $12,000. Now, the most challenging part of this are the last two steps, and basically they have to be done together. What we need to do is we need to figure out what amount of deferred profit is remaining in our deferred profit general ledger account relating to this sale. We have to pull that balance, whatever it is, out of the deferred gross profit account by making a debit to that deferred profit account. So we have to remove from the deferred gross profit liability account the amount of deferred profit remaining on that sale that defaulted. Well, the way to calculate that is to take the balance in the receivable of $12,000 and multiply it times the gross profit rate that is applicable to the sales in the year in which that sale was made, which was 12%, or sorry, 20%. So deferred gross profit here, we're going to take the balance of the receivable, $12,000, and multiply it times the 0.20 profit rate, and let's see what we get. We get $2,400. That's the remaining deferred profit on this $12,000 installment receivable. And so now the plug part of the entry, the thing that you determine last, is the amount of the loss on the repossession. Basically, the amount of the loss on the repossession is the difference between the carrying amount of the receivable amount less the deferred gross profit amount, and the fair value of the repossessed merchandise, which in this case is $1,600. So that's the end of the entry. That takes care of part B of the problem.